for real estate, it's a huge benefit owning real estate from a tax perspective. But that doesn't mean it's like a magic pill that, everyone all of a sudden doesn't pay any tax, right? You have to still have the right structure and investments. And if you're just 100% passive, you're probably not getting all the benefits. You're still getting benefits because you're still maybe not paying any tax on that income with depreciation, and you may still get cash flow distributions from it. So it's not a bad tax outcome, but it's not like it's not like you hear Trump and a lot of these others saying, oh, I pay zero tax. Well, they spend like all their time in real estate, so it's just a completely different situation, right? But to kind of go into what you should ask your CPA, number one, I would make sure that you're working with someone that kind of specializes in whatever area, or at least understands the area that you are focused in. So if you are very heavy in real estate and real estate syndications, make sure you're working with someone that actually understands these passive rules. So things you can ask them is just give them buzzwords, like passive, active, real estate professional, and see if they can talk about it, what they say. Are they just kind of like, oh no, it doesn't apply, and they don't really give you an explanation? Then maybe they don't understand the rules, or they're not looking close enough. But if they actually give you an explanation and why maybe it does or doesn't work in your case, I think that's a pretty good indicator of whether you're working with the right person. And then I would also make sure that the one mistake I think some people make is thinking that you can do whatever it is throughout the year, make whatever investments, start whatever businesses, do whatever in there, and then you get to tax season and the CPA is just going to work some magic and get you the numbers that you want to hear. But that's not the case. You have to be proactive and tell them what's going on throughout the year. So tell them if you're making a new investment, tell them if you're buying a new property, tell them if you're starting a business, tell them if you're thinking about a big asset purchase, and give them the opportunity to tell you what their take on it is. For example, if you're thinking about buying some new equipment for your business and it's already November and December, then one of the questions may be, hey, should I just wait until January? And that can make a difference. Or vice versa. I was going to wait until January, February, but I'm going to buy it anyway. Should I just do it this year? I'm going to invest in this real estate syndication. What can I expect from this, so that they can let you know ahead of time what to expect, so you don't go into tax season being blindsided or feeling blindsided because you weren't aware of it. It's a two-way street. Keep that communication open. That's really important. The last thing you want with your CPA is you only hear from them once a year at tax season when they hand you the return, right?
Yeah. Yes, absolutely. And then that's always an ongoing conversation with my CPA or my CPAs, because I have multiple on this. This allows me to kind of compare. Someone said this the best is like, well, you're not going to go with the first bids that on your roofing job. You usually get 3 bids. Why would you go with the first CPA? So maybe talking to a couple of them before you decide it would be a good idea as well.
Yeah, and referrals are always good too. If people that have had good relationships, then that's always a good place to start.
Yeah, definitely. Okay, so someone has this question back into the REAP status, which is the real estate professional status. Because we do have some content on our blog. Obviously, disclaimer, we're not CPA. It's just numerous conversations that I had with CPAs like Eric lead us to understand some of these knowledges and whatnot. So as real estate professional, someone who has that status, can the active income be offset by passive real estate income, such as LP, limited partner, syndication participation?
Yeah,
I'm
no,
assuming they're talking about negative K1s that generated by the participation into syndication as LPs.
Yeah, no, that's a great question because that kind of goes back to what we were talking to a little bit at the beginning with the grouping.
Mm,
So just to explain it a little deeper, not only do you have to be a real estate professional, but in order to be non-passive, you have to also materially participate in each activity. So that means for each rental that you own, you have to materially participate. And there's a set of criteria set by the Treasury. And I think there's like 9 different ways you can qualify as materially participating.
mm,
The go-to like gold standard is you spend 500 hours in each activity,
mm.
but a lot of people aren't going to meet that because either you're hiring out property managers or frankly it doesn't take 500 hours to manage a single family residence in 1 year.
Right.
So instead you go to other tests, which may be one of them is you spend at least 100 hours and more than anyone else in the activity. So there you're looking at if you're the only one doing everything and you spend 100 hours, then that's pretty clear. If you start having partners or other employees or other people that are involved in the management, then you have to kind of track their time. So so anyway, the grouping becomes important because in a syndication, you're probably not spending any time really. You're
Mm.
collecting, you're writing the check and then collecting checks, hopefully, right?
Right.
So the trick is that there's a special election for real estate professionals where you can group all of your rental activities as if it's one activity. So in other words, if you are a real estate professional and you have rental real estate, so let's just say you have a bunch of duplexes that you manage and then you invest in a syndication. Well, you probably, between all of those duplexes, you probably meet the material participation if you're active in some way.
Yeah.
But the
Got it.
syndication, you probably don't. So you elect to basically say it's all one. And then it kind of pulls that syndication in and you can offset that income.
Mm.
But without that election, you can't because that syndication would be passive.
Right. But it could potentially offset or defer. I like to use the word defer because taxes due at some point. Um, for example, if you had a passive investment, like you own a single family home, you sold that single family home, there's a capital gain. That's passive, right? And then possibly if in that same year, somehow you generate negative K1 from your passive investment through a syndication, etc., that is potentially deferrable.
Yeah,
Right.
well, as long as that single family home was actually passive, it may, if you were active in it, maybe it wasn't, or maybe if it's your own residence,
Right.
then
That does
that,
not. Yeah.
but your own residence, you're even better off because you still have there's an exclusion from income, right? So
Right.
married filing joint, you can exclude 500,000 of gain
Right.
when you sell your personal residence.
Yep.
But you have to live there for the last 2 out of 5 years in order
Right.
to get that. And that's a big one. I've seen people miss that by like a month or two, and it's sad because it's
It is.
that can be such a big difference in your tax bill.
Yeah. I bet.
Uh,
Yeah. Huge difference. Um, and then the REAP status, yeah, like we kind of talked about now how to qualify. It's definitely a question you should ask your CPA because there's not a one size fits all over there. We've seen all walks. Some of our investor ask us. We always emphasize on we're not CPA. You absolutely have to go check with your CPA before you make these investment decisions, right? Because you don't want to make them and then come back and find out that doesn't qualify. You want to have that during the years where it's correctable.